Welcome to Ticker.com's news channel on YouTube. On this channel, we review stock markets, discuss financial news, market trends, and economic data from Wall Street to Global Street. So let's dive in. Financial markets were choppy this week and declined for the second week in a row after inflation reports failed to calm market jitters and worries about global economic slowdown. Two U.S. inflation reports failed to calm market anxieties, and investors worried that despite this slowing inflation, prices are still rising at a faster than 2% rate preferred by the Federal Reserve. The U.S. Consumer Price Index accelerated 3.2% in July from 3% in June, but core inflation edged lower to 4.7% from 4.8%, far above the Fed's target rate of 2%. The inflation index, which understates price increases felt by the most urban families, has gone up and down largely following the trajectory of crude oil prices. Consumer inflation peaked at 9.1% in June of last year, and the inflation has been on the slide, reflecting weakness in the crude oil prices and not the Fed action. Shelter cost, which is reflecting the housing cost, jumped 0.4% on a monthly basis and rose 7.7% from a year ago and drove about 90% of inflation in July. Housing costs weigh only about one-third in the CPI index, the U.S. Bureau of Labor Statistics noted in the report. But housing inflation has been the main driver of inflation since the weakening of energy prices over the last 1 year. On the employment front, real wages rose 0.3% from the previous month, or increased about 1.1% from a year ago, slower than overall inflation, but still rising. While inflation is moving in the right direction and it has eased considerably from the 40-year high of 9.1% in June of last year, inflation is still above the Fed's target rate of 2%. Moreover, much of the decline in inflation is because of base effects, meaning higher prices last year than this year, and not Fed's doing, and interest rates are still not restrictive enough to slow economic growth. In a separate report, the Producer Price Index, the measure of wholesale inflation, accelerated to 0.8% on an annual basis in July from 0.2% in June, the U.S. Bureau of Labor Statistics reported Friday. Seasonally adjusted trade deficit shrank for the third month in a row in June to $65.5 billion, the U.S. Bureau of Economic Analysis reported this week. The U.S. is set to report goods and services trade deficit of at least $800 billion in 2023. The last time the U.S. had international trade surplus, one has to go back as far as 1964, indicating deep-seated reliance on other economies and lack of competitiveness in several industries. Let us turn our attention now to Europe. In Europe, investors reviewed German industrial production data, which provides insights into the manufacturing strength of the largest economy in the euro area. The German industrial production declined more than expected in June on weak auto production. Industrial output declined 1.5% from the previous month and fell 1.7% from a year ago in June, the Federal Statistics Office, or the Statis, reported Monday. In other news, UK home prices fell for the third month in a row in July on rising borrowing costs and elevated home prices. UK home prices have surged more than 40% in the last 3 years, and most analysts anticipate that only a half of home prices increase is likely to be reversed over the next 2 years as mortgage rates rise, meaning home prices are likely to settle at higher levels than in 2019 pre-COVID levels. The Halifax Home Price Index declined 2.4% in July after falling 2.6% in June, and average home price eased to about £285,000, lower than the peak of £294,000 reached in last August. In other UK news, the GDP unexpectedly rose 0.2% in the second quarter following a 0.1% increase in the first quarter, the Office for National Statistics reported Friday. On an annual basis, GDP expanded 0.4%, but the level of economy was still 0.2% below the pre-coronavirus level in the fourth quarter of 2019. In other economic news in the region, Italy's international trade balance swung to a surplus of €7.7 billion after energy imports plunged 54%. The National Statistics Agency ISTAT reported Friday. Italy, France, Spain, and Germany have been reporting weak trade balances after natural gas and crude oil prices soared in 2022. But the fall in imported energy prices is helping international trade balances for the last 7 months as well. Let us review economic data in Asia. This week, China reported a flood of economic news which highlighted economic struggles in the second largest economy in the world. China reported its first deflation over 2 years in July. After consumer prices declined 0.3% from flat in June, the National Bureau of Statistics reported Wednesday. Prices fell in July because of higher base previous year, and economists anticipate prices to rise in the coming months. China's producer price index declined for the 10th month in a row in July. China's inflation data following weak international trade data a day ago showed exports and imports fell in double digits in July, indicating weakening demand. China's goods exports declined for the third month in a row, and exports and imports fell by double digits in the month. Exports fell 14.5% to $282 billion, and imports fell 12.4% to $201 billion, resulting in a trade surplus of $80.6 billion, sharply lower than $103 billion a year ago. Politically sensitive exports fell 23% to the U.S., and dropped 21% to Asian countries and to the EU. Exports of rare earth materials critical for electric batteries in July soared 49% from a year earlier to 5,426 metric tons, supported by strong international demand for battery-powered vehicles and wind power systems. The sharp fall in imports was noticed by commodities market, and copper and other base metal prices came under heavy pressure. Moreover, weak exports also highlighted the slowing global demand for Chinese products and the reorienting of global supply chains away from China. China's vehicle sales in July declined 1.4% to 2.4 million units after rising 4.8% in June, the China Association of Automobile Manufacturers reported Friday. Automobile sales between January and June rose 7.9% from a year ago to 15.6 million, reflecting a sharp rebound after ending of COVID mobility restrictions. In summary, China is struggling with domestic demand, and falling exports are spilling over in the labor market. In addition, there are no signs of end of troubles in housing markets, as most home builders are expected to report huge losses. Moving on to Japan, the economic picture remained slightly better as cost of energy imports fell and domestic demand appears to be on the rise. Despite the recent pickup of inflation in Japan, household consumption expenditure over the year in real terms is still declining. The declining household consumption expenditure signaled that the central bank may take its time in lifting its interest rate range. In other news in Japan posted a current account surplus of 8 trillion yen, of 56 billion in the first half of 2023, an increase of 11% from a year ago due to smaller trade deficit and record foreign investment returns powered by weaker yen, the government data showed on Tuesday. The improvement came as the current account surplus in June roughly tripled from a year ago to 1.5 trillion yen, after a resource-scarce nation recorded its first trade surplus in nearly 2 years. The current account balance is one of the widest measures of international trade. Japan's travel surplus increased more than 12-fold from a year earlier to 1.6 trillion yen, helping trim service deficit after tourism rebounded. Looking at the third largest economy in Asia now, India is one of the few bright spots in the world, and the most populous nation continues to benefit from the sustained domestic demand and surging services exports. The Reserve Bank of India held its benchmark policy rate at 6.5%. The RBI held its rate for the third time in a row and reiterated its annual GDP growth estimate of about 6.5%. The Reserve Bank of India lifted rates by 250 basis points in 6 times starting May 2022 to 6.5%, matching the level in January 2019. In addition, the RBI left its fiscal 2024 economic growth forecast at 6.5% and revised higher its estimate of inflation to 5.4% from the previous estimate of 5.1%. We now review stock markets around the world. But first, let's look at what happened to the banks in the US, the regional banks. Moody's Services lowered its rating on 10 small and regional banks and placed large banks on its negative watch list. In wide-ranging alert about the banking industry, the rating agency belatedly highlighted fast-developing stress for small to large banks as rates continue to rise. Banks are heading into perfect storm as depositors flee for higher rates to other forms of investments, undeclared losses mount in the securities held by banks, and impending recession in early 2024 is likely to create additional headwinds to credit quality. Moody's placed Bank of New York Mellon, Cullen Frost Bankers, Northern Trust, Truist Financial, U.S. Bond Corp., and State Street under review for a possible downgrade. Most banks reported flat or modest decline in deposits, but deposit mix worsened and banks paid higher rates to retain deposits. As you can see in the next two slides, rates for the deposits are rising at a faster pace than for loans. And in the second slide, you see, which in turn shows the peaking of net interest margin for the banks. Looking at European markets turned lower following worries of global economic growth, and windfall tax on banks in Italy also dented market sentiment. Market indices in Frankfurt, Paris, London, and Milan declined after Italy imposed windfall tax on excess earnings this year to finance tax cuts and financial support for first-time homebuyers. The decision surprised markets, and banks in the region dropped as much as 3% in Germany, France, and Spain. A day later, the government was forced to clarify its intent of levying 40% tax on excess profit linked to higher interest rates with a cap of 0.1% on assets with the goal of raising only 3 billion euros. Intesa Sanpaolo, Unicredit, Banco BPM, Monte dei Paschi di Siena jumped between 2 and 4% after clarification, but the damage was done. In other news, Brent crude oil prices traded above $85 a barrel in international markets and reached a 4-month high on tighter supply conditions after Saudi Arabia and Russia extended voluntary production cuts to September. Natural gas prices in Europe edged down 5% to 38 euro per megawatt hour after soaring as much as 40% in the previous session to 40 euro per megawatt hour. The natural gas prices in Europe are down about 40% in the year so far, but are up whopping 140% from the low in June and significantly down from around 200 euro level a year ago. Natural gas prices are likely to go even higher if Australian workers carry out their threat of a long strike at 4 LNG terminals owned by Chevron and Woodside Petroleum. Let's look at the mergers and deals this week. Sobo's brands soared 25% after the pasta sauce maker agreed to be acquired by Campbell Soup for $2.3 billion or $23 a share. Including the debt, the purchase price is $2.7 billion, and Campbell said it plans to finance part of the deal with the help of new debt. Tapestry Inc., the apparel company or designer apparel company, agreed to acquire Capri Holding, the parent of Versace, for $8.5 billion or $57 a share in cash. Capri Holdings jumped 56% to $54.20. Penn Entertainment jumped after the company signed a 10-year deal with ESPN to create ESPN Bet, a sports betting site. As a part of the deal, Penn agreed to pay ESPN $1.85 billion in cash. Let us review market movers of the week. Berkshire Hathaway jumped 3% to a record high of $550,000 after the diversified conglomerate said its operating earnings jumped 6% to $10 billion, or $6,928 per Class A share. Revenue in the second quarter jumped to $92.5 billion from $76.2 billion, largely driven by the recent acquisition of Pilot Travel Centers, which generated $14.8 billion in revenue in the period. The company's cash hoard soared to $147.4 billion from $130 billion in the first quarter, and higher interest rates also helped. Rivian reported a narrower quarter loss and lifted its annual production target. Akamai Technologies reported better than expected second quarter earnings. Marqeta struck a deal with Brazil-based Fitbank and extended its deal for 4 years with Block. AppLovin reported sharply higher sales and earnings. Alibaba said sales rose 14% and earnings surged 54% in the second quarter. Czech traded higher after online textbook provider reported higher than expected revenues. Zurich Reinsurance reported higher revenues and earnings in its latest period. On the downside, Disney reported a rare quarterly loss after the company faced challenges in its streaming business. Regional banks dropped after Moody's placed several banks on negative watch list. Six Flags, the amusement park operator, reported quarterly results that surprised most investors after higher than usual reserves for insurance. International Flavors and Fragrances reported a sharp decline in earnings on inventory correction. Lyft's adjusted earnings surged, but ride-sharing company offered weak revenue growth outlook in the current quarter. UPS sales and earnings dropped after shipment volumes fell in domestic and international markets. WeWork raised the possibilities of a bankruptcy on elevated membership churn. Hapag-Lloyd fell on softening trends in price and volume for ocean freight demand. Looking ahead next week, on the earnings front, we have Home Depot, Cisco, Walmart, Deere & Company, and Target and Applied Materials scheduled to report earnings. On the U.S. economic releases, retail sales are expected to rise 0.4% and industrial production is expected to rebound following a decline in June. The other important releases include building permits and housing starts. In Europe, investors are looking forward to second quarter economic growth and final read on inflation. In Asia, China is set to announce retail sales, jobless rate, and industrial production data. India is scheduled to release consumer inflation data, and Japan is scheduled to release second quarter GDP data. That's all we have, folks, this week, and we will see you next week.